Hello and welcome to video number 2 of lesson 2, in which I will discuss the negative long-term outlook for the U.S. stock market. When I wrote the first version of my book in 2015, my conclusion, which proved to be incorrect, was that the U.S. stock market could be in a secular bear market and that gold would have a final blow-off move like in the late 1970s. In the second version of my book, written in 2019, I realized that U.S. equities were in a secular bull market and that there were quite a few similarities to the 1960s. Although I continue to hold that view, the weight of the evidence argues that U.S. equities could begin a new secular bear market very soon. Let me step back and explain the driving forces behind these major secular trends. Secular bear markets in equities usually begin with extreme overvaluation and very high ownership of stocks. Policymakers decrease interest rates and increase government spending to combat the resulting negative effects. Lower rates, and particularly declining real interest rates, helped counteract recession by reducing the debt burden and encouraging more borrowing and consumption. Increased government spending also picks up the slack. These policies are inflationary and most favorable to gold and hard assets, which are in a supply and demand imbalance due to the preceding secular bear market and years of low investment. Positive and rising real interest rates signify a healthy economic environment and usually coincide with secular bull markets in equities and often, but not always, in bonds. They keep a lid on inflation but facilitate sustainable growth. Depositors, savers, and lenders can earn a real rate of return while providing capital for productive investment. The economy and financial system are healthy enough to withstand conventional monetary policy during these periods. At lows in the business cycle, policymakers will decrease rates and increase spending, but not to the degrees seen recently, as well as in the 1930s. The trend in inflation mirrors that of commodity prices, and as a result, major turning points in commodity prices and the rate of inflation contribute to secular trend changes. Most notably, major peaks in commodity prices and the inflation rate, such as in 1920, the early 1950s, the early 1980s, and 2011, coincide with troughs in stock market valuations and the start of secular bull markets. On the other hand, as inflation begins to take hold, as it did in the mid-1930s, mid-1960s, and perhaps post-COVID, it leads to lower stock valuations and secular bear markets. In Figure 2.6, we share a chart from Barry Bannister of Stifel that calculates a 10-year expected total return for the S&P 500. The calculation, blue line, employs 3 data sets, 2 of which are valuation metrics, and the other is the percentage of household assets invested in stocks. The calculation includes returns from dividends. When the stock market peaked at the end of 2021, the blue line projected the 10-year total return at less than 1% per year. In October 2022, when the S&P 500 was trading roughly 25% off its all-time high, the blue line was projecting annual returns for 10 years of less than 4% per year. Bear in mind that the calculation includes dividends. Absent the current dividend yield on the S&P 500 of about 1.75%, the projection sees essentially the same S&P 500 price in 2031 as at the December 2021 peak. Real returns in the 1960s were quite low, but the total nominal returns appear high due to the stock market's 3% to 4% dividend yield and inflation. The data shows that the long-term upside potential of the stock market is extremely limited. The expected return metrics are at the second worst point in the past 65 years. Figure 2.7 plots the S&P 500 with its 40-month moving average, our 60-40 expected returns calculation, the CAPE ratio, and the Consumer Price Index. Let me explain the importance of these data sets. For the S&P 500, the 40-month moving average is an excellent indicator of the secular trend. The S&P 500 held above the moving average from 1985 through Let me try that again. The S&P 500 held above the average from 1985 through 2000, nearly the whole time from 1950 to 1962, and almost the entire time from 2012 through 2021. Any pronounced decline below the 40-month moving average in 2023 could signal the start of a new secular bear market. The 60-40 expected returns indicator is constructed from Yale professor Robert Shiller's excess CAPE yield indicator, which is for projecting the 10-year equity return, and the current yield on the 10-year Treasury note. It is our construction of expected returns for a classic 60-40 portfolio, 60% invested in bonds and 40% invested in stocks. 60% invested in stocks and 40% invested in bonds. As you can see, the current indicator looks much like it did in the mid-1960s. The CAPE ratio is Professor Shiller's valuation indicator, which is also used in many expected return calculations. It is calculated from the price of the S&P 500 divided by S&P 500 earnings over the preceding 10 years. At the end of 2021, the CAPE ratio reached its second highest level in over 100 years. Finally, the Consumer Price Index, which measures the inflation rate, is similar to the mid to late 1960s. The CPI had broken out at each point after many years of being in a range or long-term downtrend. In summary, the breakout of inflation after remaining dormant for many years, the historically high CAPE valuation, and the low expected returns all compare strongly to the mid-1960s. In a future lesson, we will discuss the specific reasons for higher and persistent inflation in detail. There are several. COVID and the Ukraine war have been major catalysts for reshoring, specifically of supply chains. Global trade, which increased as a share of GDP from 35% in 1985 to 61% in 2008, and kept a lid on inflation, is past its peak. According to a Gallup poll, Americans' approval of labor unions is now the highest since 1965. The factors contributing to low and stable inflation for decades, increasing globalization and global trade, labor losing power, and economic neoliberalism, are all reversing course, impacting corporate profits and record profit margins. In addition to technology, these factors helped corporate profit margins rise to new records in the last 2 decades. However, as global trade declines, the power of labor increases and corporations reorient their supply chains, record profit margins could fall back into the single digits. Figure 2.8 plots S&P 500 profit margins. The black boxes show the secular bear markets. For the reasons already discussed, the path of least resistance for profit margins will be lower over the next decade or two, and this is another reason the secular bull market is ending. Ultimately, the trigger for a new secular bear market is the S&P 500 declining below its 40-month moving average. As we pen this in February 2023, the S&P 500 is holding above that important support. If the U.S. economy enjoys a very mild recession or soft landing, the secular bull market could continue for a few more years, similar to how it did in the mid to late 1960s. However, the secular bull market will have ended if the economy falls into a hard landing and recession, which is quite possible in 2023 or 2024. That concludes lesson number 2. Thank you for watching and listening. Next up is lesson number 3, in which we discuss and analyze gold's relationship with bonds and currencies.